If you're a beginner looking to learn how to analyze a stock before investing, you're in the right place. We'll break down the process step by step, covering fundamental analysis, technical analysis, and more. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. Stock analysis is the process of evaluating a stock to determine its potential as an investment. There are two main types of stock analysis: fundamental analysis and technical analysis. We'll cover both in detail, starting with fundamental analysis. Fundamental analysis involves examining a company's financial health and its economic environment. This type of analysis focuses on various aspects like earnings, revenue, and growth potential. Let's break it down into key components. First, let's look at financial statements. These documents provide a snapshot of a company's financial performance. The three main financial statements are the balance sheet, income statement, and cash flow statement. Balance sheet. The balance sheet shows a company's assets, liabilities, and shareholders' equity at a specific point in time. Assets are what the company owns, liabilities are what it owes, and shareholders' equity is the owner's interest in the company. Key sections include current assets like cash and inventory, long-term assets like property and equipment, current liabilities like accounts payable, long-term liabilities like bonds payable, and shareholders' equity, which includes retained earnings and common stock. Income statement. The income statement, also known as the profit and loss statement, shows the company's revenue and expenses over a period of time. It provides insights into profitability by showing net income, which is revenue minus expenses. Key sections include revenue or sales, cost of goods sold, COGS, gross profit, operating expenses like salaries and rent, operating income, non-operating income and expenses, and net income. Cash flow statement. The cash flow statement shows the inflows and outflows of cash within the company. It helps investors understand how well the company generates cash to meet its debt obligations and fund its operations. The main sections are operating activities, which is cash flow from core business operations, investing activities, which is cash flow from buying and selling assets, and financing activities, which is cash flow from issuing and repaying debt and equity. Next, we analyze key financial ratios derived from these financial statements. These ratios help investors compare companies and understand their financial health. Here are a few important ones. The price to earnings, or PE ratio, measures a company's current share price relative to its per-share earnings. A high PE ratio might indicate that a stock is overvalued, while a low PE ratio might suggest it's undervalued. For example, if a company's share price is $100 and its earnings per share is $5, the PE ratio is 20. The debt-to-equity, or DE ratio, compares a company's total liabilities to its shareholders' equity. It indicates how much debt the company is using to finance its assets. A higher ratio means more debt, which can be riskier. For example, if a company has $1 million in liabilities and $2 million in equity, the DE ratio is 0.5. Return on equity, or ROE, measures a company's profitability by comparing net income to shareholders' equity. A higher ROE indicates that the company is efficiently generating profit from its equity. For example, if a company has a net income of $200,000 and shareholders' equity of $1 million, the ROE is 20%. The current ratio compares a company's current assets to its current liabilities. It helps determine if the company can pay off its short-term liabilities with its short-term assets. A ratio above 1 is generally considered good. For example, if a company has $500,000 in current assets and $250,000 in current liabilities, the current ratio is 2.0. Calculate these ratios using the data from a company's financial statements. You can find this information in annual reports or financial websites like Yahoo Finance or Google Finance. Use these ratios to compare different companies within the same industry to identify potential investment opportunities. Look for trends over time to assess the company's financial stability and growth. Earnings and growth potential are crucial factors in stock analysis. Investors look for companies with strong earnings growth, as this often leads to higher stock prices. Here's what to focus on. Earnings per share, or EPS, is calculated by dividing a company's net income by the number of outstanding shares. It indicates how much profit each share of stock generates. Consistently growing EPS is a positive sign. For example, if a company's net income is $1 million and it has 1 million outstanding shares, the EPS is $1. Revenue growth shows how much a company's sales are increasing over time. Steady revenue growth can indicate a healthy, expanding business. For example, if a company's revenue was $10 million last year and $12 million this year, the revenue growth rate is 20%. Look at the company's historical earnings growth rate and compare it to industry averages. High growth rates are attractive but can also come with higher risks. For example, a company with a 5-year average earnings growth rate of 15% might be more attractive than one with a 5% growth rate. Monitor quarterly earnings reports and compare the company's growth rates with industry benchmarks. Keep an eye on future earnings projections provided by analysts. Use this information to assess whether the company's growth prospects justify its current stock price. Look for companies with a consistent track record of earnings and revenue growth. Analyze trends in profit margins to understand how well the company is managing its costs relative to its revenue growth. Assessing a company's competitive advantage, or moat, is vital. A strong competitive advantage helps a company maintain its market position and profitability over time. Look for unique products or services, strong brand recognition, proprietary technology, patents, and economies of scale. Companies with these advantages are often better positioned for long-term success. Research the company's competitive landscape. Identify its strengths and how it differentiates itself from competitors. Read industry reports and news to understand its market position. Evaluate whether the company's competitive advantages are sustainable in the long term. Consider factors like market share, customer loyalty, and barriers to entry for competitors. Analyze the company's innovation capabilities and its ability to adapt to changing market conditions. The quality of a company's management team can significantly impact its success. Strong, experienced leadership often leads to better decision-making and business performance. Evaluating management. Look at the track record of the CEO and executive team. Assess their experience, past performance, and how long they've been with the company. Also, consider their vision for the company's future and how they communicate it to shareholders. Implementation. Review company press releases, earnings calls, and annual reports to get insights into the management's strategies and effectiveness. Consider the company's governance practices and transparency. Pay attention to management's ability to execute its strategic plans and adapt to changing market conditions. Look for evidence of shareholder-friendly policies, such as dividend payments and share buybacks. It's important to analyze the broader industry and economic factors that can impact a company's performance. This includes understanding industry trends, regulatory changes, and economic conditions. Industry analysis. Examine the overall health and growth potential of the industry. Consider factors like market size, competition, and barriers to entry. Identify key trends and challenges that could affect the industry. Economic analysis. Analyze macroeconomic indicators such as GDP growth, interest rates, inflation, and unemployment rates. These factors can influence consumer spending, business investment, and overall market conditions. Implementation. Use industry reports and economic data to assess the external environment in which the company operates. Monitor news and developments that could impact the industry and economy. Evaluate how these factors might affect the company's growth prospects and profitability. Consider the impact of regulatory changes and technological advancements on the industry. Now let's move on to technical analysis. This approach involves analyzing price movements and trading volumes to predict future stock behavior. It's particularly useful for short-term trading. Technical analysts use charts to identify patterns that can indicate future price movements. Here are a few basic patterns to get you started. Head and shoulders. This pattern indicates a potential reversal in trend. It consists of 3 peaks, with the middle peak being the highest. Double top and double bottom. These patterns signal potential reversals. A double top indicates a bearish reversal, while a double bottom suggests a bullish reversal. Support and resistance. Support levels are prices where a stock tends to stop falling, while resistance levels are prices where it tends to stop rising. Identifying these levels helps in making buy and sell decisions. Implementation. Use charting tools available on financial websites or trading platforms to practice identifying these patterns. Observe how stocks react at support and resistance levels. Use these patterns to inform your entry and exit points for trades. Combine chart patterns with technical indicators to enhance your analysis. Technical indicators help traders analyze price movements and identify potential trading opportunities. Here are a few essential indicators. Moving averages. Moving averages smooth out price data to identify trends. The 50-day and 200-day moving averages are commonly used to determine short-term and long-term trends. Relative Strength Index, RSI. RSI measures the speed and change of price movements. It ranges from 0 to 100 with values above 70 indicating overbought conditions and below 30 indicating oversold conditions. Moving Average Convergence Divergence, MACD. MACD shows the relationship between two moving averages of a stock's price. It helps identify bullish and bearish momentum. Implementation. Apply these indicators to stock charts using trading platforms. Experiment with different time frames and observe how these indicators behave under various market conditions. Combine multiple indicators to improve the accuracy of your predictions. Use backtesting to see how these indicators would have performed on historical data. Market sentiment and news can significantly impact stock prices. Keeping an eye on news related to a company, its industry, and the overall market can provide valuable insights. Implementation. Follow financial news outlets, subscribe to market updates, and monitor social media for the latest developments. Use this information to complement your fundamental and technical analysis. Be aware of the impact of macroeconomic factors like interest rates, inflation, and geopolitical events. Use sentiment analysis tools to gauge market sentiment and anticipate potential price movements. Stay informed about earnings announcements, product launches, and regulatory changes that could affect the stock. Insider activity and institutional holdings can provide additional insights into a stock's potential. Insiders are company executives and directors who have access to non-public information, while institutional investors are large entities like mutual funds and pension funds. Look for patterns in insider buying and selling. Significant insider buying can indicate confidence in the company's future prospects, while significant selling might raise red flags. High levels of institutional ownership can indicate that professional investors have confidence in the company. However, sudden changes in institutional holdings can also signal shifts in market sentiment. Use financial websites and regulatory filings to track insider activity and institutional holdings. Consider these factors alongside your fundamental and technical analysis to get a more comprehensive view of the stock. Pay attention to insider buying during market downturns as a potential sign of undervaluation. Now that you have a solid understanding of stock analysis, here are some practical steps to get started. Choose a brokerage that suits your needs and open an investment account. Ensure it offers the tools and resources necessary for stock analysis. Use the fundamental and technical analysis techniques we've discussed to research and select stocks. Start with companies you know and gradually expand your research. Diversification helps manage risk. Invest in a mix of stocks across different sectors and industries to spread risk. Regularly review your investments and stay informed about market trends. Adjust your portfolio as needed based on your analysis and changing financial goals. Stock analysis is a continuous learning process. Read books, take courses, and follow financial experts to enhance your skills. Set up watch lists on your trading platform to track the performance of stocks you're interested in. Use financial news apps to stay updated on market developments. Consider joining investment communities or forums to exchange ideas and learn from other investors. Attend webinars and workshops to deepen your understanding of stock analysis techniques. While analyzing stocks, it's important to be aware of common pitfalls that can lead to poor investment decisions. Here are a few to watch out for. Avoid only seeking information that confirms your pre-existing beliefs about a stock. Consider opposing viewpoints and conduct a balanced analysis. Frequent buying and selling can lead to high transaction costs and lower returns. Focus on long-term investments and avoid making impulsive trades. Even if a company has strong fundamentals, buying at an overvalued price can lead to disappointing returns. Pay attention to valuation metrics like PE ratio and price-to-book ratio. Be cautious of stocks that receive a lot of media attention or are hyped on social media. Conduct your own research and avoid chasing trends. Regularly review your investment decisions and learn from your mistakes. Use a checklist to ensure you consider all relevant factors before making a trade. Seek feedback from experienced investors and consider keeping a trading journal to track your thought process and outcomes. Analyzing stocks may seem complex, but with practice and the right tools, you can make informed investment decisions. Remember, patience and continuous learning are key to successful investing. We hope this video has provided you with valuable insights on how to analyze a stock. If you enjoyed this video, please like, comment, and subscribe for more content on personal finance and investing strategies. Share your thoughts and experiences with us in the comments below. See you next time with more money in your pocket.